Have you ever had like a brilliant strategy or maybe a daily habit or a meticulously researched plan that just worked flawlessly?
Oh, yeah.
I mean, for months you were just crushing it, and then out of absolutely nowhere, it completely falls apart. You didn't change a single thing about what you were doing,
Yeah.
but suddenly you were just failing spectacularly.
It is, it's an incredibly frustrating feeling, and it completely paralyzes people because, human nature is to assume you did something wrong.
Right, you blame yourself.
Exactly. You start tweaking your execution, second-guessing your entries, overanalyzing every tiny detail.
Which brings us to the core mission of today's deep dive. We're looking at why most people completely misread shifting environments, specifically in financial markets, and how to build a daily framework to actually track these shifts.
Because when that flawless strategy suddenly bankrupts you, the issue usually isn't the strategy itself.
Right. It's that you're looking at the trees and completely ignoring the forest fire. And today, I'm going to be asking the smart, clarifying questions and picking your brain, since you're the seasoned macro strategist here.
Sounds like a plan. And, that forest fire analogy is perfect because that is the fundamental trap. Most traders obsess entirely over the micro.
Like staring at minute-by-minute charts?
Yes, minute-by-minute charts, specific technical patterns, execution techniques, but they completely ignore the macro environment those setups exist inside of. I mean, a breakout strategy that performs wonderfully during a period of expanding liquidity, it will systematically drain your account in a defensive risk-off environment.
Because the rules of the game changed.
Exactly. Mean reversion systems, the ones that buy the dip and sell the rip when volatility is low, they will get absolutely destroyed during periods of macro stress. The problem is, the trader remains mentally anchored to the past. They're fighting a new reality with an old playbook.
So to survive a changing environment, I guess you first have to realize you're actually swimming in one.
You do.
And that brings up this concept of a market regime, which is a term thrown around in financial media constantly. But honestly, usually it just sounds like a fancy way of saying, well, the market is going up or the market is going down.
Which is how most people mistakenly define it. They see an uptrend and think, oh, it's a bull market, that's the regime. But a regime is much deeper than just price direction. It is the dominant behavioral condition of the market.
The behavioral condition, what does that mean practically?
It reflects the underlying plumbing. Like, how is liquidity flowing through the financial system? How is volatility behaving? How are large institutions positioning their capital? And critically, how are the correlations between different assets changing?
So it's not just a straight line up or down.
No, not at all. You can actually have a bull market that contains multiple different regimes. You can have a sideways market that looks completely flat on the surface, but underneath, it is hiding violent, aggressive sector rotations.
Okay, let me unpack this a bit. So using a mean reversion, low volatility trading strategy right in the middle of a major macro stress event, that's essentially like bringing a surfboard to a frozen lake.
That's exactly what it is.
Like the surfboard isn't broken. The state of the water just changed from liquid to solid ice. And you're sitting there wondering why you aren't catching any waves. Because the environment dictates the physics of what actually works.
The environment completely dictates the physics. But this leads to a massive misconception, People assume these environmental shifts happen overnight.
Well, yeah, don't they?
No, they think a regime change is some massive breaking news story, a huge geopolitical event, a shocking jobs report, and boom, the regime has flipped.
Let me jump in there, though, because, I mean, if institutional money is rotating over several weeks or months, how does a regular retail trader with a laptop possibly see that happening? Isn't that transition hidden behind, like, expensive terminal subscriptions and proprietary data?
That is the myth Wall Street relies on, to be honest.
Wait, really? So it's public?
The footprints are absolutely there in the public data. But retail traders are usually just looking at the wrong footprints. Regime shifts unfold gradually in small structural changes. Volatility structure begins to shift beneath the surface. Credit stress starts to bubble up out in the corporate bond market.
So the cracks are forming way before the house falls down.
Exactly. The breadth of the stock market starts to quietly deteriorate. So that big headline you eventually see on financial news. That is simply the moment the general public finally notices what the plumbing has been signaling for weeks.
Wow.
Institutional capital has already repositioned by that point.
So if these shifts are happening gradually under the surface, we really need to know exactly what climates we are shifting between. Broadly speaking, looking at the data, it points to 4 primary macro climates, plus one incredibly dangerous transitional phase.
Right.
So the first climate is the one everyone loves, right?
Yeah.
The risk-on regime. This is the environment of expanding liquidity, growing economic confidence.
It is. It's an environment that actively rewards aggressive behavior. When the market pulls back, investors buy the dip because they view weakness as a discount, not a threat.
Right.
Credit spreads tighten, which basically means investors are so confident they are willing to lend money to risky corporations for very little extra yield over safe government bonds. And small cap stocks, which really depend on cheap borrowing and a strong domestic economy, they participate heavily in the rally.
Okay, so then the inverse of that would be the risk-off regime. And this is driven by fear, uncertainty, a sudden desperation for capital preservation.
Yes.
The narrative might be banking stress or maybe a sudden recession fear, but the mechanical defining feature of a risk-off regime is that correlations between assets rise sharply toward one.
And that rising correlation is exactly why risk-off is so dangerous. In a true risk-off panic, traditional portfolio diversification often fails completely.
Because the textbook says you hold a mix, right? Stocks, bonds, gold, maybe some crypto, so that when one goes down, the other goes up.
Yeah. Exactly, that's the theory. But in a severe liquidity shock, funds are bleeding. They face margin calls. They don't sell what they want to sell. They sell what they can sell.
It's just to raise cash.
Exactly. So they dump the gold, they dump the crypto, they dump the stocks simultaneously. Everything moves together because cash is the only safe haven. Trends become highly unstable, and intraday volatility just expands aggressively.
And you see the U.S. dollar strengthen.
Yep. Treasury demand spikes, liquidity evaporates, the market severely punishes overconfidence in this climate.
Right. Which brings us to the third climate, which is the inflationary regime. And this is a really unique beast because it breaks that classic 60-40 portfolio rule entirely.
Oh, absolutely shatters it.
Because the whole premise of 60% equities and 40% bonds is that bonds provide a cushion when stocks fall. But in an inflationary environment, both equities and bonds are pressured simultaneously. And the mechanics of why that happens are actually pretty straightforward, right? I mean, if I buy a 10-year government bond paying a fixed 3% yield and suddenly inflation spikes to 8%, my fixed yield is effectively worthless.
Your purchasing power is literally melting.
Exactly. So investors sell bonds en masse, bond prices drop, their yields surge higher, and those higher yields choke off corporate growth, which causes stocks to fall at the exact same time.
You've captured the physics of it perfectly. And the thing is, when both sides of the portfolio are bleeding, the money doesn't just disappear.
Where does it go?
It rotates. Capital flows heavily into commodities, energy, cash flow sensitive sectors, and the US dollar. Rotational instability is the defining feature here.
Rotational instability, meaning what exactly?
Meaning leadership in the market changes rapidly from week to week. You also have to watch the price of oil relentlessly during this because energy costs feed directly into all economic expectations and consumer spending.
Okay, so we have risk on, risk off, and inflationary. The fourth is the deflationary or slowdown regime. So economic growth expectations weaken significantly, but inflation isn't the threat.
Right.
In this environment, long-term treasuries actually tend to outperform. Defensive sectors like utilities or consumer staples,
Yeah.
Things people have to buy regardless of the economy, they strengthen.
Yeah, people still need electricity and toothpaste.
Exactly. And you might even see large growth stocks catch a bid if the market assumes central banks are going to step in, cut interest rates, and just flood the system with liquidity to save the economy.
Those are the four core climates, but the absolute most important phase is the one that sits between them, the transitional regime.
The danger zone.
I call it the danger zone constantly. These are arguably the most destructive periods for any market participant. This is that messy phase where the old leadership is deteriorating, but the new leadership hasn't fully emerged yet.
It's like the moment the seasons change. It's not quite winter, but it's not quite spring. So you dress for snow, and it's 70 degrees, and then you dress for the beach, and you get hit by a blizzard.
Exactly. Breakouts fail, volatility increases, the various indicators you track start completely contradicting each other.
Which has to be maddening.
It is. Traders get chopped to pieces here because they stubbornly apply the logic of the previous regime, while the market is literally shifting underneath their feet. In a transition, your goal isn't to be aggressive and make a fortune. The goal is simply survival and observation.
Observation is the key word there, I think, because knowing these four climates, plus the danger zone, it doesn't help much if you don't have the instruments to measure the temperature.
Right.
We need a daily dashboard to track these shifts. But, I mean, if I'm building a dashboard and tracking all these macro indicators, there is a huge temptation to use that data to try and guess what happens tomorrow.
Which is the single most important philosophical hurdle we need to clear. The goal of this framework is not prediction. Frameworks create observation. Prediction creates emotional attachment.
Wait, say more about that. Emotional attachment.
If your goal is to predict what the market will do next Tuesday, you immediately become committed to a narrative. And human psychology dictates that once you are attached to an outcome, you will begin selectively filtering information.
Wow.
You will actively seek out data that confirms your bias and ignore the warning signs that don't.
So you basically become a defense attorney for your own bad trade, just arguing your case instead of looking at the facts.
That is exactly what happens. But if you use a framework to simply look at the data, you maintain your objectivity. You aren't trying to be a fortune teller. You are trying to be a meteorologist, just looking out the window right now, reading the current conditions.
Right.
And a useful dashboard for reading those conditions is organized into 4 specific layers of observation.
Okay, let's walk through those. Layer 1 is the macro environment. This is the broad economic backdrop. You're asking, are interest rates rising or falling? Is liquidity expanding or contracting? Is inflation cooling off?
It's a simple question.
Yeah, you aren't trying to model out GDP like some academic economist. You just want to know if the underlying gravity supports risk-taking or restricts it.
Exactly. Then layer 2 is intermarket relationships. This is how different asset classes interact with each other because markets constantly communicate through these relationships. You are specifically looking for divergences, moments where one market is calling another market a liar.
Right. And a great example of that is the relationship between stocks and credit. Let's say you see the S&P 500 rallying strongly, right? Hitting new all-time highs. The surface looks incredibly sunny.
That's great.
But at the exact same time, you look at corporate credit markets and high-yield bonds are selling off. That means bond investors are demanding higher interest rates because they perceive higher default risk. That divergence is screaming at you.
It's a huge red flag.
The equity rally lacks structural support. The stock guys are buying, but the bond guys are backing away toward the exit.
Or another classic intermarket relationship. If oil is rising aggressively while bond yields are surging, that is a flashing warning sign that inflationary pressures are returning, even if the stock market hasn't noticed yet.
Right.
Which brings us to layer 3, internal market structure, specifically looking at breadth. Breadth measures the actual quality of market participation.
Because an index can look perfectly healthy on the surface while completely rotting from the inside out.
Oh, happens all the time.
It's the old analogy of an army, where only the 5-star generals are charging forward, but all the foot soldiers are secretly retreating. It looks like an advance, but it's incredibly fragile. If the broad market index is going up, but you look at the advanced decline line and see that only a handful of massive tech giants are rising, while 490 other stocks are making new lows.
That narrow leadership is a massive warning sign.
Right.
Strong regimes have broad participation. Weak regimes rely on highly concentrated leadership to hide the deterioration underneath.
Okay, then you have the final piece, layer 4, sentiment and positioning. We use this to understand the psychological condition of the market. Are investors euphoric or are they terrified?
Right, because extreme optimism usually happens right at the most fragile, unstable peaks. And extreme pessimism happens right before a major rebound. It gives you context on whether the crowd is heavily leaning on one side of the boat.
And a really practical metric for layer 4 is the put-call ratio in the options market. Just to demystify that jargon for a second, a put option is basically buying insurance that a stock will drop, while a call option is a bet that a stock will rise.
Simple enough.
Yeah, so if you look at the ratio between the two and see an extreme surge in put buying, it means everyone in the market is suddenly paying up for crash insurance. They are terrified. And paradoxically, when everyone is fully insured and leaning bearish, it often means the selling pressure is exhausted. There's no one left to panic.
Exactly. So we have the macro gravity, intermarket relationships, internal breadth, and sentiment. Now we have to apply this in a normal 24-hour day without drowning in just a fire hose of data.
Which is the real challenge.
It is. And this is where a strict daily rhythm becomes essential. You break the trading day down into phases, starting with the pre-market. Before the opening bell in New York even rings, you are checking overnight developments. What did Asian and European markets do? Are there massive currency swings? And most importantly, you check the macroeconomic calendar. Are we getting a CPI inflation report or a Federal Reserve decision today?
Because knowing the calendar prevents you from misinterpreting volatility. I mean, if the market suddenly starts whipping around wildly at 8:30 a.m., you won't assume the world is ending if you know a major jobs report was just released. You
Yeah.
have the context.
Right. Then the bell rings, the open. The opening hour is all about seeing if those overnight moves are accepted or rejected by the broader market. It reveals institutional intent, but it is also incredibly noisy and
A
emotional.
lot of overreacting.
Huge overreactions. Retail traders are reacting to overnight news. A strong open that immediately fails and reverses downward. That tells you sentiment is actually quite fragile, but a weak, gap down open that is immediately bought by large players. That tells you there's underlying demand.
But because the open is so noisy, you need a period to find clarity, which comes during the midday assessment.
Yes.
The emotional noise of the retail crowd fades out around lunchtime. So you look at the raw data. Is the trading volume persisting? Is the breadth of the market improving? Or was the morning rally just a fake out? Midday reveals the true internal condition of the market.
Which leads to the final and really the most vital period of the entire trading session, the close.
The close, why is that the most vital?
This is where institutional positioning becomes highly visible. Large funds, mutual funds, and algorithms often execute their orders near the end of the day. They specifically track the volume-weighted average price, or VWAP. Plus, if institutions are nervous about the macro environment, they do not want to hold risk overnight while they sleep.
Because they can't react to surprise headlines.
Exactly. So a strong close, where buying volume accelerates into the final bell, signals deep confidence and continuation. A weak close, where the market sells off in the final hour after rallying all day, shows extreme fragility. Institutions are basically dumping risk before the lights go out.
Okay, so within that daily rhythm, there are also a few specific early warning signals that professionals watch relentlessly, but the retail crowd just completely ignores.
Always.
The first one we touched on earlier, the credit market. Debt markets detect default risk and liquidity stress way before the stock market does. We specifically watch high-yield credit spreads.
Yeah, to put it simply, high-yield or junk bonds are issued by companies with lower credit ratings. If the spread, meaning the difference in interest rate between those risky bonds and safe government bonds, starts widening, it means lenders are suddenly demanding much higher compensation to take on risk.
So the cost to borrow is going up for these vulnerable companies.
Right. And if they can't easily roll over their debt, bankruptcies loom. The stock market might be hitting all-time highs today, but if credit spreads are widening rapidly, equities will eventually feel that gravitational pull.
Wow. The second warning signal is volatility structure. Not just looking at the headline VIX number that flashes on financial TV, but understanding implied versus realized volatility.
This is a big one.
Realized volatility is looking in the rearview mirror, right? How much has the market actually been moving day to day over the last month? But implied volatility is looking out the windshield. How much are options traders expecting the market to move in the future?
Yes. And if the stock market is steadily drifting higher day after day with very little actual movement, low realized volatility, but underlying implied volatility metrics are suddenly expanding, it means something is wrong.
They know something is up.
Exactly. Institutional players are quietly paying higher and higher premiums to buy insurance against a drop even while the market goes up. They smell instability beneath the surface.
The third early warning signal is commodity divergence. Commodities strip away the narrative and reveal raw macro realities. The price of copper is often called Dr. Copper because it is heavily tied to industrial demand, manufacturing, global economic growth.
It has a PhD in economics.
Right. And gold, on the other hand, is tied to defensive positioning, monetary fear, and currency debasement.
So if you see the stock market pushing higher, but copper is collapsing, the physical economy is saying growth is stalling. If you start seeing oil rise aggressively while the stock market weakens, you know inflationary trouble is brewing.
And if gold is skyrocketing while growth stocks are falling.
Capital is hiding in defensive assets. Commodities don't care about a CEO's optimistic earnings call. They reflect physical supply, demand, and actual capital flows.
Okay, so the challenge for you, the listener, is how to synthesize all these data points. Copper prices, credit spreads, midday volume, put-call ratios, without immediately getting analysis paralysis. And if you try to aggressively track all of this tomorrow morning, you'll be completely overwhelmed.
Oh, you will drown. But the secret to this framework isn't complexity, it's consistency. You synthesize this fire hose of information by creating a very simple, objective scoring system. You take 5 core categories: liquidity, volatility, breadth, credit, and dollar strength. And every day, you just assign them a score from -2 to +2.
Okay, -2 means highly restrictive or bearish. +2 means highly supportive or bullish.
Exactly.
So if credit spreads are tightening and corporate borrowing looks great, maybe that's a +1 or +2. But if market breadth is terrible and only 5 tech stocks are holding up the index, that's a -2.
Right. And the crucial takeaway here is that the absolute total score on any given day doesn't really matter.
It doesn't.
No, what matters is the direction of change over time.
Because regime shifts are gradual.
Exactly. We are looking for the subtle deterioration. If your total dashboard score goes from a +6 down to a +4 and then to a +1 over the course of 3 or 4 weeks, you don't need a breaking news headline to tell you the environment is shifting from risk on to a transitional or risk off regime.
You saw the plumbing change before the water pressure dropped.
That's beautifully put. And the best way to track it is simply keeping a daily journal. Note your score. Note what sectors are leading. Note if breakouts are working or failing. Human memory is terrible at recalling market environments accurately.
We just remember how we felt.
Exactly. A physical or digital journal forces you to map the evolution objectively. Simple systems executed consistently will always outperform complex systems executed emotionally.
So let's synthesize the core of this deep dive. Success in navigating complex shifting environments isn't about having the smartest prediction or the best crystal ball. It is about having the most objective observation. By understanding the 4 macro climates, risk on, risk off, inflationary and deflationary, and tracking the daily, gradual shifts in credit, market breadth, and volatility, you stop fighting the environment. You stop taking your surfboard to the frozen lake, and you start adapting your strategy to the physics of what is actually happening.
This framework forces you to align with reality rather than your own assumptions. And, I want to leave you with a thought that extends beyond the charts.
Okay.
We've spent this entire conversation analyzing financial markets, institutional capital, and macroeconomic indicators. But think about how regime shifts apply to your own life or your own career. Environments change everywhere, often gradually and quietly beneath the surface.
Wow, yeah. Think about your industry, your workplace dynamics, or even your personal relationships. Have they quietly shifted from a risk-on growth phase, where bold moves and expansions were rewarded, into a defensive transitional phase where preservation is more important?
It's a profound question.
And if the underlying environment of your career or your life has fundamentally changed over the last year,
Yeah.
are you still stubbornly using the exact same behavioral strategy that only worked in the old environment?
Because if the regime has changed and you haven't,
You might just be holding a perfect strategy that is about to fail completely. Something to think about the next time you find yourself wondering why your flawless plan just hit a wall. Thanks for joining us on this deep dive. We'll catch you on the next one.